Welcome to this brief presentation about the income statement, also known as the profit and loss account. This is one of the three main financial statements produced annually by limited companies. The others are the statement of financial position, also known as the balance sheet, and the cash flow statement. The income statement shows the profit of a business over a period of time. It's basically quite simple. Here's one. If we want to make this more informative, we can add extra detail. One thing we can do is to take the cost of goods sold, cost of goods or services sold, and show it separately. This creates a subtotal called gross profit. Gross profit may be regarded as a measure of success or performance for the people responsible for buying and selling or for manufacturing and selling in the business. The remaining expenses can be split between operating expenses for the day-to-day running of the business and interest, also known as finance costs. Again, we get another subtotal. This time it's the operating profit. As its name suggests, this is a measure of the performance of the people responsible for all the business operations, regardless of how the business is financed. In many cases, you will see the operating expenses subdivided into distribution and administrative expenses. You'll also find a line called Other Income. This is for items not included in the gross profit, such as any profit on the sale of a non-current asset, perhaps a building. Having made a profit, the company will probably have to pay tax. This is shown at the bottom of the income statement. Once again, there is another subtotal. This time it is profit before taxation. The profit for the year belongs to the shareholders, and therefore it is one of the company's liabilities. It is added to the shareholders' funds or equity on the statement of financial position, less any cash paid to the shareholders, known as the dividends. This is a typical presentation for the published accounts of a limited company. An income statement for internal use by a company would generally contain more information, in particular a more detailed breakdown of the expenses. An income statement for a sole trader rather than a limited company would not show taxation because unincorporated businesses do not pay tax, although their owners do. As with companies, the profit increases the liability to the owner on the statement of financial position. In this case, it's part of what is known as the owner's capital. And finally, let us just go back to the cost of sales that we saw earlier. If a business makes its money by buying and selling goods, then the cost of sales is calculated as you see here. If the business manufactures products, then the purchases line is replaced by the cost of the goods manufactured. If you'd like further information about any of this, please follow the link on the next page.